Welcome everybody to today's webinar. It is in partnership with the Vermont Small Business Law Center and the CVOEO microbusiness programs. The topic today is financial risk management. Next slide, please. So housekeeping, the recording will be kept on throughout the webinar. It will be made available after the webinar so that folks can view it on their own time. Please mute yourself when you're not speaking and make sure your name remains in the Zoom window throughout so that I can get attendance. If you have any questions, Simeon and I will be monitoring the chat and making sure they get attended to, so throw them in there. And once again, after the workshop, expect to receive a copy of this presentation, all contact info that we go over, and other links to resources. So without further ado, I will pass it off to my colleague, Simeon Geigel.
Good morning, everyone. Thanks so much for joining us today. Just want to give a brief introduction to our program. So the Microbusiness Development Program is a statewide program that works with low to moderate income Vermonters to help them start or expand a business. So we provide free, no-cost business counseling services to folks. We do have some income eligibility requirements to work with our program. Specifically, folks have to live in the area that we service, which is Chittenden, Franklin, Grand Island, Addison counties. And folks need to qualify based on their total household size versus their household's total income. If you would like to learn if you qualify for our program, please don't hesitate to reach out to one of us. Our contact information is below. We have 3 business counselors at CVOEO, myself, Simeon Geigel, John Gergley, who's joining us today. Hi, John, and Pacific Sangayuva. Next slide, please. I mentioned that microbusiness is a statewide program. So if you live in another part of the state, you can access our services. You can see from a list here, these are the different organizations that focus on different areas of the state. In the southern end of the state, we have Brock, which focuses on Bennington, Rutland counties. Capstone focuses on Washington, Lamoille, East and West Orange counties. I mentioned CVOEO already. NECA focuses on the Northeast Kingdom, Caledonia, Essex, and Orleans. And finally, SEVCA focuses on Windham and Windsor counties. So this information will be included in the information that Sophia will send out after our presentation. Also, you can go to mbdp.org and access information about our services, as well as identify the business counselor for your region. Next slide. Finally, we would just like to thank some of our partners, People's Trust. People's Trust Company offers a variety of commercial and business lending products and services, as well as business consulting services to help their clients succeed. You can see here, Jay Cummings is the contact for People's Trust up in St. Albans. Really great guy and a really excellent program. So I encourage you to reach out there if you have questions or are interested in their services. Next slide, please. Finally, a thank you to our regional development corporations, specifically Greater Burlington Industrial, Franklin County, Addison County, and the Lake Champlain Islands Regional Development Corporation. So they're the state's primary partners in implementing economic development in their regions. So excellent resource. So please feel free to follow up with them if you'd like to access their services. Next slide, please. I do like to mention that there are other business support services in our area, and I'll just quickly mention them. In Burlington, we have the Burlington's Business and Workforce Development Department. We have Center for Women in Enterprise. As well, Mercy Connections, the Women's Small Business Program, which Claire is joining us from here today. We have the SBDC, Vermont Small Business Development Center, and the Small Business Administration, SBA, and finally, Champlain Valley SCORE. So there's great resources in our area for free to low-cost help for folks in our region that are looking to start or expand a business. So we hope that you will access these services and benefit. Next slide, please. So without further ado, I'd like to introduce Professor Ikes from the Vermont Small Business Law Center and the Vermont Law and Graduate School, and Sean Bronstein, who will be providing most of our presentation, I understand, today. So thank you so much to the two of you, and I really look forward to learning more about the topic today, and I will turn it over to you.
Thank you so much, Simeon. I appreciate it, and thank you for the opportunity to speak with your business clients. Um, I am Jeannie Ikes. I am the founder of the Small Business Law Center at Vermont Law and Graduate School, and the current director is Nicole Killoran. Together with several other faculty, we provide the services at the Small Business Law Center. What we provide is one-on-one legal education for small businesses and owners with legal questions. And then we provide up to 10 free hours of free legal education or free legal consultation with a lawyer after our legal education. So it's a really great program. Reach out if you have legal questions, and we're happy to help you. Today's agenda, we're going to cover the risks around running a business and specifically the financial risks of running a business. My colleague and student, Sean Bronstein, who is an advanced clinician this semester, will be running this presentation. So without further ado, Sean.
Hey, good morning, everyone. I'm gonna go off camera while I do this, just because I think it'll help stabilize the Wi-Fi where I'm at right now. So, I'm happy and I'm excited to be here. And together we're gonna start going through this awesome presentation that our clinic has put together. Next slide, please. All right. So today we're going through financial risks and managements. And here we're going to have a glossary and a summary just basically on some of the common language that we're going to use today, such as, a bargain, it's an exchange, boilerplate, which is standard language that you'll find in a contract, waivers, which are a contract to accept risks of getting hurt from voluntary activities, to protect a business and the clients as well. An NDA, which is commonly known as a non-disclosure agreement, which also provides confidentiality in whatever you're discussing within the business. Damages and remedies. This is a consequence for breaking a contract or for somebody else breaking a contract that potentially may assist your business in getting back some monies that it may have lost due to trying to correct itself from losing out on a contract. Security and collateral, valuables that lenders can take if you don't pay. A guarantee, it's a promise for payment for someone else, such as your business, and repossession or mortgage, process in taking collateral or a home to pay debt, and liens, something that attaches to property to secure payment. Next slide, please. Excellent. Here, Contracts 101, we talk about enforceable statement of a bargain, reasonably detailed in writing and signed. These are really great for those 10 free hours that the business clinic can provide with a licensed attorney. That's something great to talk about specifically when you're talking about contracts. Freedom contract is broad unless it's against public policy. 4 components to the core deal, which is the business, promises, protections, and procedures. Lawyers are pretty good at this part. They really are trying to make sure that you and the business are protected in every way possible. So it's the recommendations are typically pretty good to take at heart. But common pitfalls do happen. When you don't have a contract, there's no signature. Accepting boilerplate without really going into seeing if it's really something that you need, or you need something more specific for the business that you're doing. Lack of specifics, things do happen. Always think worst case scenario and hope for the best, basically is personally my motto. But there are several kinds of contracts here. We talk about leases, a promissory note, license, bylaws, NDAs, operating agreements, consent forms, purchase and sales, and waivers. Next slide, please.
So before we leave here, I'm going to jump in and be a law professor for a second.
Love it.
I want to reassure everyone that contracts are okay. In fact, they're good things. We should have contracts with other businesses who we're doing business with. Why, you might ask? Well, the heart of this presentation is financial risk. What do contracts do? Contracts are a way that we come together and we form a meeting of the minds. And then we write it down somewhere so that we remember it. I don't know about you all, but I'm getting older, and sometimes those niggly little details fall out of my mind because of all the other things I'm trying to remember. So having those things in writing helps keep everyone on the same page. It's extraordinarily useful, and it's not a way to start off on the wrong foot with someone to ask for an agreement. Having an agreement just means that you're coming together and forming a strong foundation to collaborate. So things like a lease, they ensure both your rights and the landlord's rights. If you're taking out a lease, or if you're the landlord, it ensures your rights as a landlord. So when you do business, have that lease for where you're doing business. Create the promissory note for lending. Get the license or issue a license. Licensing is great. When you have something you can license, you can earn income from that license, right? All of these contracts are things that businesses create to mitigate financial risk. If you don't have a good contract and it's not signed, if it's boilerplate and it doesn't really describe the deal you're doing, then it's not a good contract. A contract isn't something you just check a box on. A contract is really where you sit down and you put on paper what you intend to do and get the sign off from both parties. Okay. It's really crucial to make sure that you're on the same page when you're doing business. So always take that time. And as Sean said, lawyers are good at the procedural stuff, the boilerplate stuff, like indemnification and the things that you might not think about that are legal terms of art and buzzwords in the law. Yeah, leave that to the lawyer. But when you come to the lawyer, have a good idea of what you want that deal to be, and then get that contract written up in good legal terminology. That's one of the things those 10 free hours can be used for, folks. So run with it. Make those contracts, and you can create a template agreement that you use. Let's say you sell web design services. Those web design services, you can have a contract that you use repeatedly for those web design services, and then that core part of the deal that you can become a scope of services. That's just a business document that you attach to every contract, and you can have the lawyer work up something you use over and over again for your agreements. Lots of ways to do contracts. All right, Sean.
Excellent. Thank you so much, Professor. So in contract law, the slides today are considered specifically for Vermont state law. So if you're functioning in another state, always want to check the other state as well in case you're there as well. So when we're talking about case law, we're talking about what is a bargain, what other examples have been brought forward to a case in front of a court, and what has the court said specifically in regards to that. What is an acceptance and what is a counteroffer? If I accept, I'm going to get 10 widgets at $1 each. And then you come back down and say, how about you get 10 widgets at $2 each? Is that a counteroffer, or am I accepting that as well? What kinds of damages or relief can you get? So expectation damages and then an injunction or recession. Expectation damages specifically would be if you were to expect a certain amount of money and then you didn't get that specifically, then you could request the damages from that. Statutory law. This is specifically for attorneys. I left this in here because these are things that the attorney that you could work with would specifically handle. And these include the sales of goods and secured transactions like your collateral, security interests, and repossessions.
Let's quickly revisit the kinds of damages, because
Sure.
one of the things I really want to make clear to people is you have an obligation under a contract to staunch the bleeding, right? So if you rely on someone to deliver your flour, for example, and that retailer or that wholesaler is not delivering your flour for your bread making company. They just stopped doing it. You have to start seeking someone else to deliver that flour. You can't just wait around for your damages to pile up and hope to gain those damages back when you sue them because they weren't delivering your flour that you rely on to make your bread, right? So you have an obligation under contract law to try to make sure that you do everything you can to stop further damages. However, they do have an obligation under that contract, and you relied on them to provide something to you. And that's another reason for the contract, folks, right? It helps us establish those responsibilities. So if someone is injured, meaning when I say injured, not physically, like, financially injured, right? Because you were expecting something from someone else, you can then say to them, yes, I relied on you for this. Here's the evidence of it in the contract. You promised that you would do this for me for X amount of money and you would deliver on a weekly basis. And I haven't seen flour from you in a month and a half, right? I went out and found another contractor 2 weeks out because I couldn't bake bread anymore and you didn't provide the services. I lost revenue, and you have some ability to go back on this person and say, I paid more for the flour. You owe me for that difference. And I lost revenue because I couldn't bake flour for 2 weeks while I waited for a new contract to get put in place for a new flour provider. So you have the ability to regain some of those damages. It's one of the reasons we write these contracts is so you're secure and you don't lose a business because someone else failed to perform what they were obligated to do for you. Go ahead, Sean.
Excellent. Thank you so much. So debt risks. This is great. So debt can be a pro and a con in a business depending on the situation. Specifically, we're going to talk here about immediate debts, purchases and sales of goods. So those are your receivables that you have, line of credits that you could receive from either funders or banks, overdrafts, which aren't always great, but they do happen. So just keep notice of those. Ongoing debt. When we're talking about long-term performance contracts, a long-term performance contract would be like if a manufacturer agrees to pay an X amount of dollars for widgets for X period of time for future manufacturing, that's an ongoing debt that you're going to have with a manufacturer. And the same thing if a company has promised future delivery, 2 weeks of pay for an employee is an outstanding debt that the business may have if you have employees. It's something that you have on the books, but you haven't paid it yet. For leases.
So think about the example I was giving when we were talking about this the other day, Sean, was sick leave. At the end of the year, if someone has accrued 2 weeks of unpaid sick leave, that's still an ongoing obligation you have as a business, even though it hasn't been paid out yet. So you accumulate long-term performance debt or long-term debt in these performance contracts where you are obligated to do something. One of the things we didn't talk about here and we didn't note is there are ways to reduce all of these risks. So this immediate debt risk, like for example, overdraft is an immediate debt. What's one of the ways you can manage that? Well, you talk to your bank about overdraft protection, right? So there are some things that a business can do to offset some of these risks as you move forward. Go ahead, Sean.
Yes. Also, with the overdraft, if you have a good relationship with a bank, sometimes you can ask for a courtesy where they provide the money back to you in case you encounter a fee. Sometimes if you have with credit unions are pretty good with that as well. If it's a continuous thing, not so much, but if it's a one-off, they typically are really good with that, especially with small businesses.
And they can do things like a sweep account.
Exactly.
That will really support the small business and if you're busy trying to sell your goods, sometimes you don't have your finger on the pulse of your bank account every moment of every day. And having that sweep account can take money from a savings and put it into a checking account or other things depending on where you needed the funds at the time.
Yes, excellent. Professor, do you mind just mentioning what a sweep account specifically is, just in case people aren't familiar with that?
I think Simeon has a question really quick. Simeon?
Oh, thank you. I was just going to ask you to define what that is too.
A sweep account is when a bank will pull in money from one account into another account, and use that to pay debts or to basically they attach your checking account maybe to your line of credit, or they can attach your checking account to a savings account you have, or they can even, in some cases, if you are a sole proprietor, attach a personal account to a business account. So there are ways in which, and then sweep the money from one account into another account on an ongoing basis to assure that you have the balance you need in that account to pay your debts.
Great, thank you.
Awesome. Thank you so much. Let's see, where do we leave off? Future and conditional debt. So stock buyouts, which could be an unknown debt at the time. You're not sure what the stock price will be now, and then in the future. 5 years from now, when the business is really booming, the stock price likely will be much higher than it is for today's value.
So Sean, when do we usually see these kinds of conditions, like a stock buyout? When does that happen for a business?
Typically, it's pretty popular to see either when they're going to sell the business or they're looking to have another partner come into the business, or they're trying to use use it as collateral for additional funding for growth.
And so the challenge with that is the stock prices might be low at the beginning, but high towards the end of the agreement. And if stock has appreciated 150%, clearly your future, what you owe in the future, by offering people just a couple of stocks when they go to sell them out back, is much greater.
Absolutely. This happened back when Apple was first coming out. And then you talk about stock splits and, you go down that rabbit hole. So yes, later on and throughout the business, the stock does become more valuable in time.
In the tech startup boom, what we saw a lot of is people getting paid with stock.
Yes. Yeah, I think
And
that
then
happens.
and they get paid with stock, and then they go to leave the company and they want to cash their stock in. And it can be actually a lot more than what they would have been paid as salary in the initial situation. So, that can be not only a future conditional debt, it can be a debt that is unpredictable, right? And so
Yes.
that enhances the risk.
Yes, absolutely. Equity cash outs. Your operating agreement will specifically state that. We go on that a little bit later on with operating agreements. Operating agreements are so important for a business. It basically says what you can and can't do within the business. There's ways to change them, but always having something to fall back on, especially if you have a partner. You're going into, think of it as you're getting married, you're in that honeymoon phase and everything's great, but then there's something starts souring a little bit and you need to refer back, or somebody's not pulling their weight. What are the remedies that you can ensure that your business continues to thrive? Liens and mortgages, UCCs, and those are specifically when if you're looking to use your business assets as collateral, sometimes a bank or a I can't think of the terminology, but basically like a guardian angel investor will they want to attach a lien to it so that if the business starts to go under, they have something that they can basically sell to get some of their money back. And
Additionally, if a business has creditors, they can put a lien on something the business owns, so that should the business go through bankruptcy or some other thing, they can have first right to the sale of that particular asset.
yes. And then errors and omissions. Professor, would you mind taking errors and omissions, please?
Errors and omissions. So errors and omissions are when you don't do something right and you forget, right? Or accidents happen, right? Or your professional judgment was just wrong. You didn't have the facts right, right? These things happen. And when you break an agreement or when you injure another or their property through an errors and omission, you didn't get the snow off the roof, it slid down and it hit somebody. As we'll talk about later in the insurance slide, there are ways to insure yourself for errors and omission, and there are also ways to make sure that they don't become personal liability and that they stay with the business. So we'll talk about that when we talk about entity formation and protections for entities.
Excellent. Next slide, please.
Simeon, you have a question?
Oh, yeah, I was just wondering, would it be okay if we just took a quick pause to check in with people to see if they had any questions at this point or needed anything clarified that you've gone over?
Absolutely. This has been a little drinking from a fire hose,
Yeah, right.
and I certainly respect that this is hard stuff. Um, as I like to tell people when we're giving these lectures, we spend a whole semester, sometimes a year on these topics with students in law school. So the fact that we're giving this to you in such a short period and you're taking it all in is frankly a credit to you and is remarkable. So
So
And
just,
we have questions.
yep, just anybody have any questions or need anything clarified? We'll take silence as a no.
all
right.
right.
Thank you.
You're welcome.
All right, let's see. Debts and entities in Vermont. So specifically, again, these are for Vermont. What to do when debt and business entities, what do debt and business entities have to do with each other? It's a great question. So sole proprietors, partnerships, and unofficial partnerships. So that's basically when a partnership agreement hasn't been formed, but there's two or more individuals that are working within a business. Your assets are basically your business's assets, and your creditors can be taken for business debts. This means that they're one of the same. There is your laptop is both your personal laptop and a business laptop, and it can be clawed back. Specifically, there's no protection, basically, so to speak.
Anytime somebody sues you, if you're a sole proprietor or a partner, they are suing not just the business, they're suing you. So they can take your house. They can take your car in the judgment.
And your personal checking accounts. So if you have money in there that you have, they can take that as well.
Your assets are completely and fully on the line for any liabilities that your business incurs if you are a sole proprietor or a partner.
So the way to protect that is you form an LLC, you have limited partnerships, you form a corporation, etc. Those are limited liability protection from the business debts, specifically stating it's now creating a barrier between the business that you have formed and your personal items. And the only time that does not basically protect an owner from debt is when the owner personally is responsible for hurting someone. The owner failed to separate themselves from the business, meaning you have a corporation and you have a business account and a personal account, and you're continuously putting money in both of them and exchanging money in them. You're now basically you're separating that wall. You're removing that wall. You're making it one of the same.
It is extraordinarily important not to do what we refer to as commingling the funds between your personal assets and your business assets. So for example, Sean, the business or the bank account is a great example. The thing we often see small businesses do is reach into a till and hand the kid $10 for lunch money, right? And that is taking your business and your personal and commingling them. You cannot do that. You cannot have take your business checking account and bring it over to your personal checking account to pay this month's oil bill, right? Those sorts of things break down that protection, and the limit for liability if someone sues you will go away because the judge in the court case will see that you did not treat your business and your personal life separately, and therefore will reach into your personal life just as you reached into your business for your needs, the judge will reach into your personal assets for the court's needs.
Yes, it happens all the time. So the ways to protect that is you form your LLC, your limited partnership agreements, and your corporations, and you keep them separate. The other big thing that happens that a lot of people don't realize is when you personally guarantee a debt. So let's say you need a loan for your business and you go to get a $50,000 loan, but the bank goes, you know what, we want you to personally guarantee this. That now means that not only is the business signing for it, but you personally are. So if the business closes, you now are personally responsible for that $50,000 debt that you have signed for.
The other little gotcha here is business owners are so often signing their own name for everything because they own the business. You need to indicate when you're doing that signature, president or owner of XYZ company, right? On behalf of XYZ company. However you choose to sign it, making that signature distinct from your personal checking account signature is really crucial to, again, ensuring that that wall stays between you and your personal assets and your business assets.
One of the things that I did note here, Professor, is I did specifically put a corporate veil. Basically, think of like Wizard of Oz, don't look behind the curtain type thing. Keep that curtain up as much as you can between the two to protect yourself and protect your business.
Absolutely.
Excellent. Next slide, please.
Excuse me, I just had a question. This is John, and I'm sorry you can't see me, but my camera's not working. But going back to that previous slide, could you say a little more about the
I'm trying to go back
separation?
to the previous slide. Uh-oh. Thank you. Okay.
Oh,
go
thank
ahead.
you. Yeah. The second to last bullet about the owner failed to separate themselves. Could
That's
you give me
that's
another example or two about what that means?
so those are the signatures. Those are farms. Let's say you're using your tractor around for all of your personal garden, and then you take it out and you use it for the field, right? That use of a good for both business and home use becomes one of those lines you shouldn't cross. You really have to isolate the assets of the business for business purposes. You shouldn't use your company kitchen to bake all of your Christmas cookies that you give out to friends and family, right? So anytime you're using business things for personal use, it becomes questionable to the court and can reduce that veil between the business and the person.
But what might be an example on those, using those scenarios you just mentioned? What would be a potential harm that would arise?
In the case of a lawsuit, right?
Yeah, but how would a lawsuit using the example of the cook?
It doesn't have to be related to how you commingled, right? In fact, it isn't most likely related to how you commingled. So somebody was walking into your cafe where you baked your Christmas cookies for your family, right? And when they walked into your cafe, they slipped and fell. They sue you, right? Your cafe isn't really turning enough profit to pay out on that. However, you have a checking or a personal bank account that does. Because you commingled and you didn't create enough separation between the personal and the business, the court will say it's the same thing.
Okay, all right.
And therefore, we can reach into your personal bank account to pay that liability, that debt.
Yeah, okay. Well, that's a good reason to tell clients to have separate business bank accounts, I suppose. It's because there are so many things for our clients typically who are so under-resourced to begin with. These separations are at times difficult for them.
They're extraordinarily difficult. And this is one of those reasons why documenting everything like this is so crucial. Just write it down. Make sure you have a separate bank account. Make sure that your bookkeeping is clear and precise. Um, it's going to be really hard for anybody to catch you on the cookie thing, but someone could make that argument and it could damage your credibility in court saying that you're not a sole proprietorship, you're an LLC. You see what I mean? It's all about that business, that
Yeah,
legal title, right?
yeah, yeah.
So many small mom and pop businesses are, like the country store, right? And I used the example of somebody handing $10 out of the till to the kid for lunch money, right? Um, that kind of thing is just normal, or using the rake from home and the is to rake your leaves that you would use to rake the lawn for your business, right? It's those sorts of things where the equipment isn't kept separate, where things commingle, that starts to reduce the liability protections of having an LLC.
Okay. All right. Thank you for that.
You're welcome. Simeon?
Yeah, just along the lines of John's question, one, would part of that in terms of having your ducks in a row there, would that also include, for example, if you're an LLC, you would want to make sure that you had an operating agreement complete?
Yes, and we have a slide on that coming up.
Great, great. Also, I'm not sure if this question fits into this, but it does come up. So how does this all work if the business is uh, like a husband wife or a partnership like that?
Partnership, unless they're legally an LLC, then they are considered a sole proprietor or partnership, and personal assets are on the line for business debt.
Okay.
If you, just because you're a husband and wife doesn't mean you shouldn't be co-owners of the LLC.
Mhm.
Always would recommend to people, the LLC is so easy in Vermont. There's a little added expense, but in the scheme of things, we're talking about $300 a year. We're not talking about a lot of money. And the reduction in risk is so much that it's well worth it.
And for the $300, are you referring to like the business entity tax there and the annual report one is
I am.
filed? Okay,
I am.
okay.
And that's the recurring fee. There's an initial filing fee,
Mhm.
but again, that's not a huge initial filing fee either. That's pretty low.
Yep. Okay. Great. Thank you. Just wanted to clarify that.
Yeah,
And
absolutely.
Melissa, just want to make sure you're okay with your question. You got it answered?
And there was one more that was just posted as well.
Okay.
Yeah, so I'm opening a fitness studio, renting space from an entity. So if I've never been told something like Melissa as manager member of, so that's fascinating information to me. But if I'm the owner, should I sign it as owner?
If you're a sole proprietorship, it doesn't matter because
I'm an
everything's,
LLC.
if you're an LLC, yeah, sign it as owner or member or manager.
Hmm. And where do I literally say that?
And I just put it after your name parenthetically.
Oh,
Like you could put that in the signature area of your email, like when you're sign off your email. Is that what you
Yeah,
essentially?
exactly. Comma owner.
Yeah. Okay. That's what I thought.
Yeah, it's not, it just creates that little bit of distinction. And as long as you're consistent with that, whenever you do business on behalf of your LLC, it's going to strengthen. It's evidence that you separate your personal assets from your business assets. It's about building up a strong foundation of evidence demonstrating that you treat your business as an entity that is separate from you.
okay. Thank you.
You're welcome. You ready for the next slide, Sean?
I'm ready.
Alrighty.
Excellent. Thank you so much. So this slide specifically is both good information for both how to receive money that is owed to the business, and then also on how a customer or client can also receive money from you if you owe them. So vice versa. This is a recourse basically. So here we have collections as unsecured debt, and that goes into if somebody's owed money but they haven't put a lien on your business, these are ways that they could potentially collect, or you could collect. Providing a phone call or a letter to them, voluntary payment, meaning that they've gone ahead or you've gone ahead and paid it, or lawsuit, and which could impact your credit reporting. So even businesses have credit reporting. And if there's questions about that or information that is needed, we certainly could provide some of that as well, if there is any of that. Alternative dispute resolution. So this is like negotiations or mediations or arbitration. Sometimes in different contracts, arbitration will be listed as how to solve a dispute. And that basically means that it wouldn't go to a court. Instead, there would be a third party person that would come in and would basically look at both of the situations, the business's side and the person that's either owed money or owes the business money. And then we'll make a decision based on the information that is presented to them. And that usually is a lot cheaper than going through negotiation or mediation. But again, it depends on the type of business that it is.
I would add to that oftentimes this is a clause in your contract that instead of going to court to settle disputes based around the contract, it'll be mediated or negotiated.
Yes. Small claim court options. There are always court options unless there's arbitration. And those include small claims court, which is up to $5,000 for damages, typically quicker, and doesn't typically require an attorney. In fact, sometimes the courts prefer you not to have an attorney, but it doesn't mean that you can't have one. But Superior Court, there's no cap on damages. Those you're going to find typically for higher dollar amounts. And it's definitely more formal and typically would be beneficial to have an attorney for those. You're talking like, I'd say over $10,000, or if there's something that's really impeding your business or something of that capacity. And then collecting judgments. This is
before we leave court options.
Sure.
I just want to underline several times when it can be avoided, avoid going to court.
Yes.
One of the things we do not share enough, I think, is that of cases that are filed in this country, only 3% of the ones filed, the complaints filed, actually end up in court with a judgment. The rest are settled. All right, settlement is the goal. So even if you file, you may file to let the other party know you're serious, but the goal is settlement. Always settle. You may not settle for everything you're owed, but it's so much cheaper than going to court in the long run. So know, and it's faster. Know that yes, you have court options, but unless it's small claims, you're better off negotiating. Almost always.
And so much less stress. I just want to point that out. Less stress as well.
Because that matters too, right?
Yes. Especially if you are in a growing business and you want to just keep plugging away. Absolutely.
Or you do not want the media circus that may come with a big court case. I mean, it can impact your brand and your reputation if you're litigious.
Yes. Collecting judgments. This could be in garnishments of wages or bank account. And so typically this right here, I just want to state that this is after a court has made a decision or there's been arbitration where actually, Professor, I'm not sure if in arbitration, if they can actually issue a garnishment order.
I think that's going to be jurisdictional.
Okay, so there we go. I don't believe Vermont has that. So in collecting judgments, garnishment of wages or a bank account, so basically a garnishment would go into your bank account and they could take money out. The one interesting thing that they can't do though is if that bank account is for payroll, and that has to be specifically outlined with the bank. If that account is for payroll, that can't be deducted because they can't attach employee wages. And that I can actually get a link to and put that in here shortly. Recording liens on property. That's basically your assets or any type of physical property that you may have, real estate property. And again, your till or cash from the till. They can come in and take that. So again, these are options for recourse on how a business owner or others towards the business can pursue and collect debts from the consumer or the business owner.
Simeon,
Yeah, this also just seems like a good area to put a little plug in for the Vermont Attorney General as they help try to resolve issues between customers and businesses.
that's a great point.
Yeah, just wanted to mention that. And also, I've heard of mechanic liens. Are you able to define what that is and how that would be used?
A mechanics lien. So typically, mechanics lien, I believe that's more in a construction business. If something or some type of work was done and the service wasn't paid for, I believe that they can go ahead and file something with the Secretary of State. But
Yeah.
please correct me, Professor, if
No,
that is.
that's correct. Mechanics liens generally are for services that are unpaid, and the lien generally attaches to whatever was created.
And is that something that an individual can do, or is that something a lawyer would need to do? Do you know?
I honestly don't know. Being a lawyer, I do them.
Okay. Okay.
So I don't know.
That's okay.
It's a town clerk process for some liens.
Okay.
And it has to be registered at the clerk because sometimes liens can be they can impact the title of property.
Hmm.
And so you can end up with a bad title and an inability to sell a property because of a lien.
Yeah. Okay. All right. Thank you.
And then also, if I may add to that as well, is it's always good to run it by, you can talk to the Secretary of State, usually the Attorney General, because if you don't perfect a lien when you go to do it, the lien can be considered not valid. So if money is owed and you've spent the money to register that lien, they actually can come back and say it's not valid and you have to go through the process again to perfect it.
Okay. Thank you, Sean.
All right, next slide, please. Excellent. So these are secured debts. So very similar to the other one previously. These are ways to secure debt that is either owed to you or that is owed by you. And so we talk about collateral that is put up for the loan to encourage the lender to lend. So if you're looking for a line of credit and you're a fairly new business, but you've got a lot of commercial equipment, the bank is more the bank is happier to lend you the money if it has something that should the business not succeed, that it can claw back and basically cover some of its loss. And again, mechanism for securing debt is a mortgage or a lien, mechanics lien, with land records or filing a UCC lien with the Secretary of State. Again, that goes to the business assets. And then it's more challenging to collect, and it's a procedural requirement. So typically there is a process that you would need to go through, or the business would need to go through to either obtain a lien or to remove a lien. And that would be basically paying it. Options as well. Repossession of personal property or assets. This basically means when the items are basically forcibly taken from you, where they collect them back. And it's the same with the foreclosure, be it residential or commercial property. We see a lot of both of these when we're talking about bankruptcy sometimes, or right before bankruptcy. Processes, and we will talk about bankruptcy in the next couple of slides. I just want to put that as well. There is a process to this. Property secured, a vehicle repoed, a court order gives the bank something called a writ of possession for a vehicle, for a house, for some type of real estate, and basically states that the court is ordering you to turn over an asset. property sold at auction for fair market value. Something that's common that people don't realize is if an individual ends up in a position where their property is sold at auction, you actually can go and bid on that property. As long as you have the collateral or the ability to purchase it, you could actually go back and get the items back. And then debt left owing is collected against the business and or the owners, depending on if they have signed a personal guarantee. So again, it's another great reason as to have that, again, that corporate veil, that wall put up between the business and personal as well.
And a quick little note on the mechanics liens. Mechanics lien creates a cloud on the property title, and that was the term of art I was looking for a minute ago that I wasn't able to come up with off the top of my head. And a cloud on the title makes it difficult to refinance, mortgage, or sell the property without first settling that debt. One of the interesting things about mechanics liens is they do not usually impact somebody's credit rating or credit score. So while they can be powerful, it can take a long while to actually get what you're owed if you place a lien.
Yes. Great thing. Bankruptcy and grace. So we're going to talk a little bit about bankruptcy. And these are some terms of art that most attorneys will use. I'm going to simplify it, but I did want to provide it just in case you decide to take this and want to Google some more information. But basically, bankruptcy can be both a benefit and a detriment, but there is a lot of misconceptions about bankruptcy. Bankruptcy really could benefit a business depending on what the situation is. And so we'll go through that here, I believe, in the next slide.
Bankruptcy really protects a business against their creditors for a period of time. And it's sometimes enough time to allow a business to get their house in order, but it has to be done early enough in the process for it to be helpful. Oftentimes businesses, particularly small businesses, wait too long to file bankruptcy. And by then they're just looking at ending their business and trying to get out of it without too many of their personal assets being leveraged.
Yes. And I do want
Simeon raised his hand, Sean. Sorry to interrupt.
No, absolutely. Go ahead.
Sorry to interrupt, but Professor, that was a really interesting point, and I'm just curious, and I'm sure it ranges for different people and situations, but at what point should somebody really be looking at that, if so they're not waiting till the end to lose everything? Like when should they be considering doing that bankruptcy?
When a business can't pay their debts and they do not see a solution on the horizon. And when I say that, I mean have a contract in hand. I mean not hope, right? And there's a difference between money on the table or being placed on the table. Then I hope we're going to land this contract 3 months from now, right? That should not be a consideration. So if you're 30, 60, 90 days out on what you owe people, you're starting to, at 90 days, if you really can't pay your bills, that's starting to look like a place. The other place is when you can't pay your employees. That starts getting into a lot of legal risk. And you really want to make sure your employees get paid. So if a business is ever in a situation where they're not going to be able to pay their employees, they need to be looking at ways to forestall their creditors so that they can pay their employees. And that's another good time to consider bankruptcy. Bankruptcy is a court of equity. It is not a civil court. It's not adversarial. Bankruptcy is about coming to the table and trying to find ways to restructure debt so that payments can be made and the business can survive. The goal of bankruptcy is to leave everyone as whole as possible. We don't think about that. We think about it as an evil thing, and actually bankruptcy and the process of bankruptcy was historically created to avoid that nasty debtor's prison that they had in England. Um, and we don't consider it like that in the United States. So bankruptcy is the solution.
Thank you, Professor. Out of curiosity, if you apply for bankruptcy, is it true that that won't protect you from your obligations of payroll? Do you know?
I don't know off the top of my head. Perhaps Sean, you can answer that. You've taken that course most recently.
So it would depend. And I say it would depend is a lot of times what happens is if a business can't pay its payroll, a lot of times all businesses, as long as they're conducting appropriately, they're paying into unemployment, into the Department of Labor. And typically there are funds set up with the Department of Labor for things that when a business does shut down and they can't pay their employees, the employees can get funding from there. But on the back end, what ends up happening is that individual that could not pay the business's payroll ends up becoming liable unless they personally file for bankruptcy, because they have signed to the Department of Labor or to the state that they basically are going to ensure that the business pays its debts. But again, bankruptcy does happen. These things do happen, but there typically is a recourse with that. But employee can get their funds from different protections that they have at the Department of Labor. I hope is that more so of what you were asking?
Yeah, thank you, Sean. I appreciate
Okay.
it.
Of course. So those are basically that's your insurance that you pay, which is why it's always important to pay that. In fact, businesses will get hit with exceptional fees if they do not pay their unemployment tax or their business tax through the Department of Labor. If there's any tax that you pay specifically, you need to make sure that, pay them all, but that is the most important.
The unemployment insurance is just
Yes.
critical.
Yes.
And it's not even called a tax. It's called unemployment insurance. And the rate at which they charge you for that really depends on the kind of business. For example, seasonal businesses like ski industries who lay off seasonally pay a much higher level of unemployment insurance.
Yes. And the other thing that is notable is if an individual does not pay into that and they decide to close and open another business, they still have to register with the Department of Labor. They actually will not be able to close and open up another business if there's outstanding debts that are owed to the Department of Labor. And you'll see that in insurance as well. If you skip out on like rooms and meals tax, and you don't pay those, insurance carriers can actually deny you for not paying other companies' rooms and meals tax. I've seen it before.
Melissa, you have a question?
Yes. So I believe in the state of Vermont that I'm allowed to pay my fitness instructors as subcontractors. Is that correct?
It is going to first, that's specific legal advice, and we're here to educate today. So I'm sorry to say we can't answer that specifically.
Okay.
But what I would say is independent contractors have a lot of requirements to fit the bill. If this is not done right, you could end up with a lot of deferred payments that accumulate interest with the state of Vermont, as well as fees for misidentifying an independent contractor. It is really, really messy if you don't get this right. So a lot of that will hinge on the way in which a business creates a contract with an independent contractor. It generally, for example, I'll use office space. Let's say you do hoteling office space where you provide computer access and access to Word and the Microsoft Office suite on a computer. And they're providing ad hoc administrative assistant skills that you happen to market for them. This is getting to be a complicated scenario to make my point. Sorry about this. So what in those situations, it would be really, really critical to say, hey, this equipment that you're using, I'm leasing that to you. Because the person has to bring their own equipment and has to have all of their own equipment to be considered an independent contractor. So you can end up really easily if they use any of your equipment and you don't have it written out as a lease, to be looking like an employee. You gotta be really careful here. And it's not just the unemployment insurance, you end up with back taxes. Because there's an employer obligation on taxes and there's a huge financial risk, both to federal and state taxes on this. You do not want to get in a place. I've seen businesses close and lose their businesses completely over this distinction between employee and independent contractor. So it's really important to get with an attorney about this and get that question sussed out for you specifically and how you have your business set up, because all of these really tiny little details, like what I just mentioned about equipment, matter. And an attorney
Okay.
can help you for your individual situation, figure that out.
Thank you.
You're welcome. Go ahead, Sean.
Awesome. Thanks so much, Professor. Great questions, everyone. So debt, when we talk about bankruptcy, Professor Ikes went over about it's an equitable distribution of assets to creditors. Everybody, doesn't matter how much is owed to each person. Everybody gets the same amount. Even if you have a high dollar amount and somebody else has a low dollar amount, everybody gets the same amount. It gives you an opportunity, gives a business an opportunity to stop, rethink about restructuring the business and to either restart it or continue by offering some type of plan to either get out of the debt or to close and reopen in a different capacity. Debt is sorted by priority. This means the secured. So when we talk about secured, we're talking like a mortgage on your house or a lien on your business, just like a car loan, where the bank has the first right to the car. And if you don't pay, they can take the car. Your tax liens, sewer bills typically are a big one for that. Also your property taxes, equipment liens, for any business like commercial equipment that you may have that a bank has signed a lien with. Unsecured priority. So alimony and maintenance, child support, employee wages and benefits, tax obligations. These typically are also going to take priority as well, especially when you're talking about child support. I think actually the state puts that one almost as the first to be able to take a bite at the apple, so to speak. Unsecured non-priority is everything else, your credit cards, your medical expenses, personal loans, and assets that are not exempt are put into trusts and sold to pay creditors. And that's really if it comes down to you're closing up, there's no way to restructure the business and you just have too much debt and you've decided that it's just best to close. A trustee, which oversees the process, will come in and they'll basically take everything and then sell it at auction or try and get somebody to pay an amount for the entire lot. Next slide, please. So this goes over the different types of bankruptcies. Bankruptcy, again, it's a way to either one, save the business by reorganization and plan that, or two, a way to properly close a business if it's not sustainable within the debt load that you currently have. So again, it could be a great opportunity to reorganize and move forward. The case managers that you guys have access to in a lot of the programs, they can help guide you as well if you need support with this. Individual bankruptcy follows a business if there's a personal guarantee on anything. So you would still be, even if the business closes and you've signed for a line of credit, you are still responsible for that. The only way to not become responsible for that typically would be to personally file bankruptcy. So there are different options, which are here. Chapter 7 is considered liquidation. It means that you're selling everything and you pay what you can and you walk away. The bonus on that, and I say the bonus, yes, you just closed the business, but you are able to start fresh. You are coming out of that with zero debt. And there are courses that you have to take for credit. I forget the name of it, but basically it goes over how to basically not to come into debt again. The downside to that is there usually is a small hit to your credit, your business credit. If you decide you want to reopen, it does drop, but there are ways to build that back up. Chapter 13 is known as a catch-up or the 3 to 5 year plan. So essentially, the business is being reorganized to pay on the debt. And this is not available to corporations specifically, but I believe it is open to LLCs and to personal. But definitely correct me if I'm not accurate there, Professor. Typically with businesses, you're going to larger businesses, will be this Chapter 11 reorganization. The thing with this one is it's fairly expensive and it's very, very paper heavy. Unless you're a company similar to like Amazon or Walmart, I haven't seen smaller companies do a Chapter 11 just because of the cost of it. And then Chapter 12 is very common, similar to a Chapter 13 for agriculture. This is good for agriculture on how to restructure their business and continue. The thing with these is the businesses can still operate while they're going through bankruptcies 13, 11, and 12. There's somebody that comes in to assist the business on how to ensure that it's meeting its obligation by lowering the debt that is basically owed. And basically there's a sit down and a compromise. Typically it's known for dollars, pennies to the dollar. Where you're still paying the debt, but you're paying what you can pay at the time. And a lot of times what happens is business owners or personally, you will only pay pennies to the dollars. And once you've done that, the rest of the debt is wiped out.
And this is a good way for both sides to get as much as possible. Again, keep in mind that even these catch-up plans, you may not be left owing the whole amount. Your creditors would rather get paid something rather than nothing. And so they're going to work with you to make that happen.
Yes, that is correct. And again, this is another reason why it's so important to have that corporate veil specifically where you're having business versus personal. Next slide, please.
Simeon, you had a question there?
Yeah, if you're able to, filing bankruptcy isn't free. Are you able to kind of give a sense about what a typical small business would pay to file bankruptcy?
Sure. I actually took the bankruptcy course, I think it was about a year ago, at Vermont Law and Graduate. And typically with a smaller business, the filing fees, I think, are a couple $100, and then an attorney, depending on how much assets there are, what's the amount of work that needs to be put in. It's anywhere between $2,000 to $4,000 for like a Chapter 7. But sometimes what they can do is they can roll it in to the actual bankruptcy. If you are on the lower side where you have zero assets, sometimes the court will actually waive some of those fees, but you still have to pay the attorney because there is a significant amount of paperwork that's involved. But again, there are grants available. There are clinics, specifically the veteran law clinic at the school. If a veteran needed to file for bankruptcy, if they fell within the income guidelines, they actually can provide that free of charge to the veteran. And there also are other low income legal services available that do file these. So sometimes you can get those attorneys' fees waived. It just depends on what the financial situation is of that individual. When you're talking about a 13, a 11, and a 12, so 11, 12, and 13, those are more costly. And it depends on the amount of assets. Sometimes again, they can roll it in and use it as a line item to deduct once they've sold some of the assets. But it just depends again on the amount of the money. The smaller businesses, you're looking most likely at a 7 to come out from it, or reorganization, which is a 13.
Thank you. And for like, I guess it's the chapter 7, I can't see it from the slide, but yeah, thank you. So what would the time frame be for filing chapter 7 for a small business? How many months are they looking at for the process?
Sure. So we have, I believe her name is Judge Heather Cooper. I believe that's the judge that's overseeing the bankruptcy court in Vermont. Typically, once there's something called an automatic stay. So once a business or a person has decided that bankruptcy is the only option, they've gone through with an attorney, and the attorney also suggests it. They get all the bills that they're owed to different vendors or personally to any banks or lien holders, and they do something called an automatic stay, and that's filing the petition. So what that means is there's nobody can come and ask for money until it's put in front of a trustee, and that could take anywhere from 6 to 8 weeks. And then what happens from there is the individual or the business will go to bankruptcy court. And then once at the bankruptcy court, the trustee will review everything, and they'll go over if there's any options, how much of the assets are. They'll verify the documentation that has been provided to the court. And sometimes there's things that come out of the woodwork. Sometimes businesses will file just to restart, and it's disingenuous, and the trustee will pick up on that and will actually discharge the bankruptcy and not authorize any charges to be any debts to be cleared. And that individual would then have to figure out what is their recourse for that. That doesn't happen very often. We saw that in the Murdoch cases. I believe it was kind of like white collar crime. But for small businesses, it's anywhere from 6 to 8 weeks. And then once the trustee stamps off on it, it's then a couple of months before everything is done. I think overall it's 90 to 120 days. And then from there, what happens is there's a waiting period. However, between that 90 and 120 days, if the individual wanted to try and protect like their home or their auto from being repossessed, they can reaffirm that debt with the trustee's permission. But if they do that, they are back on the hook for that debt, meaning it's not discharged. And so once that is done, the trustee will sign off on that and they'll move forward. But again, I think 90 to 120 days. And from there, typically you'll see it on the credit for anywhere from 7 to 10 years that there was a bankruptcy on there. But almost immediately, once it's discharged from the court, and the court has given a business owner or a person clearance, and they have discharged the debts, they'll not only will that person see their credit start to rise back up again after it's been taken a hit, but they'll see immediate offers for credit. And it's important to know that while that is a great thing to receive those, to just be careful going back into the debt, because you're now within a window that the trustee can look to see if you're just accruing additional debt. I hope that didn't go too deep into the rabbit hole and that answered the question you were looking for.
So one of the things I'd like to point out here is at the end in our resources, one of the resources we have is a great video on bankruptcy that was done as a panel with Judge Colleen Brown, who was our bankruptcy court judge before she retired, I think 2 years ago. So that's an SBDC video, and we've linked to it at the end of the presentation.
That's great. Thank you so much. And yes, Sean, it did answer my question. Can you remind us, once you declare bankruptcy, how long do you have to wait to declare it again?
That will depend. So there's something called a catch-21, I believe is the term that they use, or a catch-20. when a 7 and a 13 can be combined. It's not very often, but there are ways that typically it's 7 or I think it's 7 or 8 years you have to wait for a chapter 7, and chapter 13 you have to be out of the wait period, which I believe is 5 years.
Right.
There are ways to do them back to back, 7 and 13, or 13 then transferred into a 7. But the thing with that, if you go to do that, if you do a chapter 13 as the secondary, you don't get a discharge from that bankruptcy. So it's kind of like you're in purgatory for a period of time. The only way to close that out is you have to contact each creditor to state that there's 0 debt owed.
Okay, thank you.
Of course.
All right, I'm going to do the next slide.
Okay. So common blind spots, and how can we avoid them? This is a great thing. Personal guarantees, avoid them if you can. Sign for the business. So we use Professor X gave a great example on how to sign for a check or sign for a lease. If I was to do it, I would do Sean acting as member or manager of ABC LLC, or president of ABC Incorporated. So that way I'm clearly dividing that this is for my business and it's not for me personally. Reading contracts. Even if you're not familiar with all the information that's in it, it's always a great idea to read the contract so you know what you're agreeing to. And if at any time you have questions about that contract, always ask. And then the 10 hours that we can offer with a licensed attorney is also a great opportunity to read over some contracts and ask questions about those. And in order to read over the contract, it's important to actually have the contract. So knowing what you're agreeing to, knowing what somebody else is agreeing to be able to see if everything is being followed appropriately. Again, having lawyers read it. You can talk with us. One of the great things is once you contact the business law clinic at Vermont Law and Graduate School, we, as the clinicians, the students, we actually get to do a deep dive into a lot of the questions that you ask, and we can provide educational consults. And what that does is it's a win-win. It's a win to be able to provide education for you as the entrepreneur, and it's a way for us to understand more of the intricacies of how businesses are established, formed, interesting questions that come up all the time. And it gives us an opportunity to learn. Something that we learned today is staying a sole proprietor is risky line of business. And that is because you are not providing a clear, definitive line between you and the business that is being established. It can actually be a detriment to you. And the best thing to do is to protect the business that you're working so hard and you're putting the blood, sweat, and tears into creating. One of the great things also that we do want to mention is having an operating agreement as an LLC when you're having a partner. And it puts things into protections and, are we going to be able to have additional partners come in? Are we going to be able to, what if I want to close the LLC? What if I don't want to do this anymore? How do I do that? How do I close the business? How can I start?
We always use the marriage and prenuptial agreement example here, because when you're in the honeymoon, everything's going great, everybody's positive, you're just starting up the business. It's a wonderful time. If you're having disagreements there, it's probably not a good sign. But in that startup phase, usually everybody drank the Kool-Aid and everybody's optimistic. But when something goes wrong, you want to have worked it out when everybody had good feelings. You wanted to figure out how you'd proceed if somebody gets hit by a bus, if one of the partners, decides they don't want to do this anymore. How are you going to move the business forward? Will the business close and everybody will get a share of whatever's left? Or do you want the business to be able to go on and sustain, and the other members buy out the member that wants to leave? All of those things can be put into an operating agreement in advance, and it really saves disputes later on. And I want to underline something to me and ask about husband and wife situations. having an operating agreement is particularly important in a case where the husband and wife own the business, because not all marriages are successful, and not all businesses are successful. And when those are tangled up, it can sort of amplify the challenges that may be faced on one. Either the business problems cause problems in the marriage, or the marriage problems cause problems in the business. And you want to have a nice agreement there that's solid, so that the folks that are having an emotional roller coaster ride in some other way aren't having a business that's going through the same thing.
Absolutely. I think Simeon had a question. He has his hand raised, I believe.
Oh, thank you. Yeah, it was on this topic of operating agreements. It's been mentioned before that even if you are a sole member, just you in the LLC, that you should still have an operating agreement. Is that something you would suggest as well? And if so, what's the rationale for that?
This again is about keeping your business separate from your personal life. Having that operating agreement is your procedure for how you do business. Whether you are one person or you're 20 people, having a procedure for how you consistently do business allows the court to look back in a liability situation and say, oh, look, they were acting as an entity, not an individual. And so that operating agreement is more evidence that in fact you are keeping your personal separate from your business.
Great. And the operating agreement, that's not something that has to be on file with the Vermont Secretary of State. That could just live in somebody's file cabinet in their home. Is that true?
Absolutely.
Okay.
Absolutely. It's important. It's important when you have an operating agreement to have signatures on it. It is another form of contract. So it's really important to date it and have signatures on it. The court finds it less persuasive when the operating agreement was signed a week after the complaint was filed than if it started with the business, right? So getting those operating agreements in place in the first 6 months of your business is really critical. It's better to have it done before you start the business, but if not, and in the scheme of things, sometimes they don't get done until 6 months in. Yeah, that's kind of to be expected. But later than that, and it starts looking like it was done ad hoc to avoid a conflict, and that again becomes suspect.
Thank you.
I do want to add something as well here, if I can.
Please do.
The other thing, when we're talking about, if an individual is married, and sometimes what happens when married individuals work in a business together, sometimes there's the questions of infidelity that arise, and then it's them versus me, and you need to get out of the business. This will also detail how to get out of the business appropriately, so that you get what is owed to you. If you put X dollars into the business, it's a way that it's a bargaining chip that you can use to get out of the business, and how to do it the best way possible. So it really comes down to protecting you. Or if you go through a divorce, sometimes if it's a sole proprietor, the bank can use that as more ways to add up for additional alimony or things of that extent. So it's that becomes, I believe Vermont is a community property division. So, you're one of the same, sole proprietor. So it's, again, just another way to protect the business and yourself. We talked about ignoring debts. If you can't pay them or negotiate with negotiate with the creditors, get things in writing. And then also see about if you're ignoring the debts, talk to your managers. Talk to the managers that we have here. I believe there's some names good at the front that can also provide some assistance with that. And then reporting to the bankruptcy, reporting to credit bureaus, at least one of them, that can actually benefit a business when you're doing business. And if you're doing, if you have loans and you're paying off those loans, just like a personally guarantee, when your personal credit reports, your business also has a credit report. Again, considering bankruptcy as an option, it's a safety net, and it's an excellent tool if you believe that the business can continue, but you just need help reorganizing the debts that you have incurred.
And there's another reason to think about this as preventing a financial risk. If you have a conflict over a sum, um, the opposing party could try to report that on your credit report that you haven't paid. And technically that might be right, but if you are refusing to pay for what is a legitimate reason, you want that noted in the credit report at the same time. So you want to note that it's disputed. And this is another reason to reach out and to talk to credit reporting bureaus and really get anything documented so that there's an explanation.
Yes, absolutely. Data privacy. Actually, Professor Ikes is the very proficient in the data privacy world. If any personal identifiable customer information is stored electronically, cyber insurance and data privacy policy is absolutely pertinent to the business as well.
Have one, right? If you allow personally identifiable information to go out, you've committed a, an indiscretion that can have criminal repercussions and it can have civil repercussions. So you have to be careful with people's data, and you can take financial risk when you take on their data. What we recommend in these circumstances is third-party agreements. So what does that mean? That means do not take credit card numbers and store them in an Excel spreadsheet on your computer. Instead, it should be done with a tool like Squarespace or something of that nature, where you swipe the card and the third party company that you signed an agreement with takes all of the liability for how that credit card information is handled and how the banking information is handled. So always, when possible, use a third party that is set up for that purpose, and always have cyber insurance if you can.
Excellent points. Thank you so much. And then when we're talking about permitting regulatory compliance, these are the compliances that you or a business need to do in order to stay in the good graces of the Department of Labor, the Secretary of State, and your town zoning administrators. Definitely talk to your neighbors, talk to those around you, talk to a lawyer to see what permits you might need. Again, another plug for those great 10 hours that you can get for free just by coming to do a consultation with us at the Small Business Clinic. Insurance protection against the unknown. I can't say how much this is important.
The law protects you, and insurance fights your battles for you.
Yes, especially after what just happened with COVID. There's a lot of things that we saw in contracts, force majeure clauses and things of that caliber, where they didn't have to go through with some things, but not having your business interrupted and not having insurance to protect you through those really made some businesses make or break in order to thrive after COVID. And insurance, it literally just protects you against the unknown. Something could happen in the future. You never know. A great example of, somebody walks in on a cafe, they slip and fall, and it's the difference between saving your personal assets and your business assets. Talk to insurance agent. They're free. There's policy options, best practices, what activities in a business like yours they would consider to be risky. There's great difference between running and owning a nightclub versus baking bread. They're two distinct different businesses, so no two businesses are alike. And the one cool thing about having an insurance agent or a broker is you fill out an application and they put it into a pool of insurance carriers, and insurance carriers will actually bid on being able to provide insurance to a business that the individual has. And a lot of times that will come in, it can come in different. So it's always good to look at the different policies and see what best fits both financially and the options for protecting the businesses. And some types of insurance that we have just here are general liability, protects against slip and falls, falling ice, injuries on premises, Malpractice. This is great and as actually most likely required on the business. It protects against professional mistakes, typically healthcare, legal professionals. And also, I believe it goes as far as like massage therapy and things of those professions. Errors and omissions protects against corporate officer errors and omissions. Flood insurance after what just happened this July and last July. It's pretty wise to look at special policies to protect against flood damages. And flood is usually excluded otherwise. Business income interruptions, replaces lost income when there's a disruption in your regular business. As well as cyber insurance. It protects against financial losses in the event of a data breach or cyber attack. And one of the things to think about is if you sat down and just thought about it, what would happen if XYZ happened to my business? How can I protect both myself and my business? Look at the different insurances that are available and absolutely talk with an attorney and an insurance broker that can assist with that.
And one of the nice things about insurance brokers is often they give you so much information, things you didn't think of as risks that they will highlight as risks for you that you can just take direct action against, so you don't have that risk any longer. They are a great resource for how to avoid risks.
This is John again. I would just mention that we have a free resource, insurance resource that we've used for the last couple of years. Travis Spencer at Kinney Insurance offers free guidance to our clients about insurance, and he's made it very clear he's not selling them, but he's provided a lot of good advice to a lot of clients over the last couple of years.
That's great information. Thank you.
That is great information. Thanks. Next slide, please. So here is these are the slides that will be going out later today. If you're interested in coming to talk with us and you need legal services, submit an inquiry on the link right here. And what this does, it goes to our website and it will ask, what's your business about? What are you looking for? Or what's a legal question that you may have? Or what's going on with the business that you think that you need an attorney for? Or, hey, I'm looking to form a entity. I don't know if I should do an LLC or corporation. And what will then happen is it will go to our director and then it will come to the students and we get to do a bunch of cool research and find out what is the best type of entity suggestion for different types of businesses that may be similar. We can't give legal advice, but we can do something called an educational consult, and it's at no cost to you. And it's at no cost to anybody that comes to us. And then once you have done an educational consult, you can get up to 10 hours paid with an attorney that can help with contracts, can help with pretty much any legal question that we could offer as far as within those 10 hours. If you're interested and you have a patent that you're looking to do or copyright questions, those are all things that we can assist with. And we can also provide helpful materials, legal resources to guide you, group educational presentations upon request, like we've done today. And then also on the next slide, we've included some resources. One of the cool things I like to do when I do presentations or if I'm providing a one-on-one consult, I always like to include grant information on, even though you're a small business, typically when you're looking at grants, you think that they're only for nonprofits. There are some grants available for small businesses or micro businesses. And a lot of times it will depend on the type of business that is being conducted, the individual, if it's a female-run business or a veteran-owned business or things of that capacity. Definitely take a look at those. It doesn't guarantee that you'll get it, but you don't know unless you try. And then for the top of the resources, Professor Ikes mentioned here about information about bankruptcy at this link right here. We've included that. And the insurance, again, just a reminder, it helps to protect against anything unknown that might happen in the future. And Professor Ikes, I'd like to bring it back to you and open up the floor for any questions.
Absolutely. I'm going to stop sharing my screen and we'll take any questions that you might have. Does anyone have any questions?
I don't have a question, Professor, but I would just like to put a plug in for services you provide, the educational session and the 10 free hours. I mentioned that to everybody that I work with, and I've connected many folks that I work with to that resource, and I just can't sing the praises enough. So I'm so glad that that resource exists in our community now. So thank you so much for that. It's really making a big difference in filling a void.
I second that. I mean, I didn't even know that that existed, and the 10 free hours of educational advice after is really such a gift for somebody who's just starting a new business. And I didn't even know that there were possible, I'm not saying I'm going to get a grant, but I didn't even know that there were possible grants available to new businesses. So I'm excited to get this PowerPoint so that I can start clicking through and figuring out what's available. So thank you so much.
You're welcome. What I'd like to do is send you an updated, Sean, can you send that PowerPoint to
Absolutely.
Sophia? That would be
Yes.
wonderful. And we will be able to share that out after this presentation.
Thank you all for joining us today, and thank you to Sean and Professor Ikes for leading this wonderful presentation, and to Simeon Geigel, of course, for making sure all the questions get answered and asking valuable questions that will live on as a resource. And I would just like to plug that next month on the 19th of December, 2024, for those watching on YouTube, we are having another session this time around on litigation and dispute management. So if you'd like to sign up, that registration link will also be in the follow-up email.
And I would just like to double down on that. The questions Simeon asks are some of the best we get in any presentation. So thank you very much for those as well. They really help us come down from the law school to talking to everyone and making what we say understandable. So thank you so much.
Oh, well, thank you. I appreciate that. And thank you both, of course, for taking your time and sharing your time and knowledge and expertise with everybody. We really, really do appreciate it. And I would be remiss if I didn't thank Sophia for all the background help she provides. I couldn't do this without her. So thank you, Sophia.
Absolutely. Sophia is a wonder.
Yeah, she is.
Thank you all. Stop the recording
All
here.
right.